All right, good afternoon, everybody, and welcome to today's webinar on integrating investment and wealth management services. We'll be getting started in just a couple of minutes. Thanks for joining. All right, I see that that the people are signing on at a good clip here. So while that's happening, I'll go ahead and cover a couple of things for today. We've put together a panel that you can see on your screen right now that's going to help to guide today's discussion. But we want to hear from all of you in the audience as well, and we've given you a couple of ways to do that. The best way to join the conversation is to click on the raise your hand button, which you'll see at the bottom of your screen. That'll allow me to actually bring you into our panel here. You'll show up on the screen with a video if you're set up to do that, but otherwise you can just run with your voice as well. That's really the best way to get involved. The other way that you have to send us your questions and comments is using the chat function. I'll be keeping my eye out for messages that come in through the chat throughout today's event, and I'll do my best to monitor those and make sure that those questions get answered. But either way that you choose to join today's conversation, either through the chat or through by raising your hand, we do really want to hear from you. I see that we're a few minutes past now, so I think we'll go ahead and get started. I'm going to just briefly share my screen. One of the lessons that we've learned, having been through many webinars at this point, as I'm sure all of you have, is that discussion seems to flow a little better when, rather than staring at a screen like this or looking at a chart, right, you're actually able to see the folks that we've brought together to be part of our virtual study group today. Once again, welcome to today's webinar on integrating investment and wealth management services. My name is Tim Kehrer. I'm a research director with Kehrer Bielan Research and Consulting. We're happy to be hosting today's event. We wouldn't be able to hold today's event at all if it weren't for the support of our sponsors. I want to thank them. Today's sponsors are Ameriprise Financial Institutions Group, eMoney, and we'd also like to thank our friends at Jackson for their support of today's event. Thanks to you all. I also want to take a moment to introduce today's virtual study group, today's virtual roundtable. Again, I'm going to leave this screen up for just a second, but I'm going to stop sharing my screen because I think it's better if you can see everyone's faces while I give you their names. We'll email this around. I think we emailed it around earlier as well. On today's panel, hello everybody. On today's panel, we have Rome's Hour from First Horizon Advisors, Kelly Brennan from eMoney, Jim Fujinaga from Hancock Whitney, Bruce Hageman from BBVA Securities, David Hansen from Fulton Financial Advisors, Jim King from Arvest Wealth Management, Chris Melton from Ameriprise Financial. We also have, in addition to myself, a couple other members of the Kehrer Bielan team, our principals, Ken Kehrer and Peter Bielan. And as I mentioned at the top, all of you in the audience, we want to bring you into this conversation as much as possible. So please send us your questions and comments either by clicking the raise your hand button or sending us a chat. With that, I'm going to turn it over to Ken to get us started.
Thanks, Tim, and welcome everybody. Let's kick off the conversation by asking, why are some institutions looking to change the way they're delivering wealth management? We've got some people around the table who clearly are. Jim, Fuji.
Hello. Well, we've actually done a lot of work over the last couple of years in coming to what we call the One Wealth model, but we've got a long way still to go. And one of the reasons is that we wanted to make sure that we set up the right client segmentation for high net worth clients, have the right distribution channel, the right client experience, and obviously the product set that we could offer to our customers. So we've done a tremendous amount of work putting the wealth teams together to offer that type of service. We've done a lot of investments in our sales process to lead with financial planning and provide a wide range of solutions, not just investment management and trusts, but also our RIA platform along with our life insurance platform as well. So it all starts with leading with planning. And in our wealth teams, we have a senior investment consultant, a private banker, a trust advisor, a portfolio manager, and a wealth advisor who's a CFP. So we've done a lot of work to get this team together, and we have 7 teams in our 5 states today that help support that model.
How about you, Romes? What's your motivation for change?
Thanks, Ken. There are a number of them. The primary one is that we're doing a disservice to the client if we're not holistic, if we're not looking at their entire balance sheet, if we're not providing advice that includes everything that's important to them. So in order to do that, you've got to have a model that can, and you've got to have a team that can, of specialists and generalists that can look at a client situation, look at their goals, and then customize the implementation or the plan and the implementation to what the client needs to reach their financial goals. Everybody's different. And if you're not doing that and you're being transactional, you're doing a disservice to them. And then you're leaving a lot of opportunities on the table for your company.
And that certainly seems a motivation that we've had for looking at this. Our research indicates that the typical bank has only captured about 5% of the investable assets of the bank's customer base, suggesting there's a lot being left on the table or actually being left in some other firm's pockets, right? I think, Dave, some people think that you can achieve that kind of holistic model within the old framework of the trust business and brokerage. What do you think of that?
Yeah, I'm not sure I'd characterize it exactly like that. I guess my view may be a little out of sync with most of the rest of the panelists, I think. But I think if you look back 15 years, banks had 2 defective business models. Most banks had a brokerage business that was mostly writing annuity tickets, which I think we've all learned is an unsustainable business model. And so most banks have attempted to move their brokerage business to more of an advisory-based, fee-based business model, some with great success. And then most bank trust companies or trust departments were a whole bunch of $600,000 widow and orphan accounts in a business that's literally a dying business. The trust business has declined by about 40% in the last 10 years by account size or by account numbers. And so you had 2 businesses, neither one of which is sustainable. So you had to change something, and you either improved them both by doing what I've already said on your brokerage business, making it advisory oriented and changing the way your FAs deal with clients. And your trust platform is a really good platform to run a comprehensive team-based wealth management business, as opposed to more of a single RM FA business, if you've got the patience and the aptitude to build it. But it's really, really hard to build. So I think if you can have both of those businesses on your platform, as we do, they both can be really, really effective businesses. If you can't, then maybe integration is the way to go.
Mm-hmm. And I guess, Jim King, you've never really had this integration problem. Oops, I think you're muted.
Excuse me, sorry for that, Ken. Yeah, we started years ago, and much to the wisdom of our chairman and the owner of the bank, the trust and brokerage group have been together for all the years, probably going on 30 years now that Arvest Wealth Management's been around. So we have really focused on providing those services together to our customers and our on a team approach in our local markets. And so we've done it. I think we've done it fairly effectively. It's a constant challenge, though, to keep the integration to work together. The folks that work in those two areas and those two disciplines aren't exactly the exact same kind of personalities oftentimes, but they can be very complementary when you get them to work together as a team. So while it's had its challenges through the years, we're really proud of what we've done, how we've done it, and really are believers that that's the way to go.
Well, let's sort of drill down into the various ways one can integrate. When I first learned about this business, I saw that between trust and brokerage, you really had an oil and water kind of dichotomy, that they provided different advice to the same customer. They were paid differently for that advice, and they were compensated differently for providing that advice. Trends have moved to blur those lines clearly, as Dave mentioned, as the brokerage moved more towards an advice model. But there are still important differences. So one area of potential integration are integrating the sales forces, to having a sales force, an advisor who could sell trust products and brokerage products, or provide trust advice, asset management advice, and brokerage advice. Who's doing something like that, and what are the barriers to making that work?
Hey, Ken, this is Bruce. I'll take that one. Kind of go backwards a little bit. What were the challenges for us? As you just said, it was oil and water. We had two competing models. If you were in brokerage, you hated trust, and if you're in trust, you hated brokerage. And always were constantly fighting against each other. The trust people thought the brokers made too much money. The brokerage thought the trust people got too big of a base salary. They were always at each other's throat. And so, starting, I've had the honor of starting in 2014 when the bank said, let's go down this journey. I run BBVA Investment Services, which is made up of the broker-dealer, the RIA, the insurance company, the asset management group, the trust group, and financial planning. And we finally all got that put together at the end of 2018. But the missing link really is what you were talking about, is the financial advisor has to own all of those. Because if today we have a wealth RM, a financial consultant, they both do their role. We team it up with a PM, portfolio strat manager, and then you've got a trust officer that's with that same team. But when the financial consultant would say, well, that's a piece of trust business, they put up their hands and they walk away, it never got over to the portfolio manager. And then if the portfolio manager found that a client needed brokerage business, they just threw up their hands and it never got referred to the FC. And today, that happens naturally now in the wealth group, where the financial consultant, he's responsible for the goals of all of those lines of business, not just making his own. And I think that's made the big difference. And of course, then you got to have the same management team. We have the same management team overseeing that group as well. So I think that's made the big difference for us. And actually 2020, our wealth division, first time ever, they're going to make gold. They've always, they always made their numbers on the asset management and trust side, but on brokerage side, it was a number that's embarrassing to talk about. But we've had huge growth, and it was a true commitment hiring Brian Kuholtz at the end of 2018. He put the right culture into place. He's moved on now to retail, and we hired a new guy, but put the right culture in place and said, hey, wealth clients need brokerage business just like, affluent clients need discretionary business. It's got to all be working together. So I think, and then the compensation, as you mentioned, they get compensated the same way as if they use the RIA platform or they use the trust platform. And now with the way that we're paying on brokerage, it's not so far off. So there's not that big gaps between the product sets that we pay them on. And more than ever, you guys know we are always a big annuity. I think Jim said that. Always sold a ton of annuities, still do to retail customers, the true downside. But now we've got a true wealth product set and a sales force to deliver it along with the wealth team. Thanks.
Hey Bruce, we just had a question come in over the chat directed to you. This is from Mark Ganung. The question is, did you experience any turnover as you changed your model?
Yes. The turnover, though, was actually on the portfolio manager side. The portfolio managers, just the ones that we had in place, truly believed that discretionary business was the only way to go, and to put it on the trust platform, and only if you have $1 million or more. And about half of the portfolio managers left. But it is amazing. You think they're going to take all their assets with you. If they have $500 million book, you think it's all going to go. It's amazing how sticky it is because you have the relationship with the RM and the FC in there and the trust officer. But what's been great is the ones that we hire now under the new model, you're hiring the right people for the right model. And so, but also we didn't lose turnover in the financial consultants, but some of them chose to stay more on the retail side. They don't want to volunteer to come over to the wealth side. So we didn't lose them, but there's some people you're just never going to change their mind. And this was the way to do it. And there is a little bit of sacrifice on turnover, but the people that you actually hire in that support the program, you got to change that culture because one bad apple, So yes, we did have turnover.
So Ken, one of the things that we see going in and out of a lot of financial institutions is kind of what Bruce and Jim and Jim said is they've kind of tiered their business. The models that we've seen working the best, whether it's a bank-owned broker dealer or you're with a third party, is where they've kind of got these teams as you've talked about, both Bruce talked about and Jim Fujinaga talked about. And I think is that the model that most of you are thinking through, so that you've got your branch-based advisors beginning to tier your business a bit? Because I find by teaming those folks up like that, you really have the ability to focus on a different tier of the business in a way that's very effective and offer that more well-rounded advice-based approach. And that's what I'm seeing working. And I'm just curious if you guys have actually tiered your business that way.
That's actually why we haven't integrated, because we have our FAs aimed at the $1 million and down market that works really, really effectively with a single FA as opposed to a team. That business is not as sticky as that team-based business Bruce was just talking about, but I'm willing to concede that for the $1 million and down clientele. But the $1 million and up market, I want served by a team that makes it more institutionally sticky, and it converts my business model to being more of a fixed expense base and less of a variable expense base. So we have our brokerage platform named at the affluent and mass affluent market, and our wealth platform or our trust-based platform aimed at the $1 million and up. Really, 3 million is where I want them to be, but we kind of have a jump ball in that $1 million to 3 million world.
So you seem to be saying that teams may be important for the more upscale market, but aren't necessary for the mass affluent market.
That's my view.
Mm-hmm.
Yeah, and from my view, I agree. From my view, that geography is a lot of it, right? If you're in a small town, you're not going to have that team, and you got to have that FC service more. And we're the same way. We're going to a minimum of 3 million for the wealth platform. We start that in September, and keeping the lower end in a different. Still get the same service, but you got to be 3 million to be wealth. But we do have a pocket, so I want to let people know the team works in Houston and Dallas and Phoenix and Birmingham and the big cities. But I got a lot of small towns where I got to have that model where that financial consultant can serve all the needs out there, and they represent wealth, even though they're mainly a retail broker. Sorry, Jim, go ahead.
Gee, Bruce, that seems so 2019. I would think that now as we become more proficient virtually, there's no reason why someone in a small town, small community couldn't be virtually part of a broader team, right?
Absolutely, you're correct.
Jim, I'm sorry, you're going to say something?
Well, I was going to stay on that topic of teams because I agree. We believe in teams for these higher net worth customers. But we also found is that you just can't stick 5 people in a meeting. You have to have the right process and the right people there. Everyone that does show up, we require well, first of all, we have a preparation meeting prior to the meeting, and then we have debriefs on every single meeting that occurs with a customer, and then a follow-up plan that goes with it after the client or after the prospect becomes a client. So we have a defined structured process now for the teams to follow, as opposed to everyone trying to go out there and trying to offer one thing. So we've done a lot of work to ensure that that structure is in place for the sales process. Because we found too many times when we had too many teams, sometimes we overwhelmed the customer and some of the individuals were going off target. So it's important to have a good plan and be prepared for those meetings. But we believe in a team structure for our high net worth clients.
I would think that that's a real human resources challenge to get people who really want to work in teams. A lot of very successful people are really, lone wolves. And I would imagine that not only at the sort of client-facing level, but management as well. People didn't come to top management positions by the teams they were on. They got there with their own working one-on-one. So I would think that a big challenge to pulling this off is finding the right people.
It is for us too. Oh, I was just going to add to that. You're right. You may have a challenge there, and we do have regional managers that head every one of the 7 wealth teams to stay on top of the structure and the process. But on top of that, with our branch FAs, we developed another role called a senior financial advisor that's able to cross lines and bring in the wealth team for some of their high net worth clients and still be involved. Because for these senior FAs who've already proven themselves through planning, through managed money, and through insurance being holistic, we've given that opportunity. So they may not be sitting in a hub directly, but they still have the ability to work with them and therefore not feel like they're the junior varsity as well when they're sitting on the branch land and not able to work with some of the high net worth clients. So that's really become a career path for us in our organization.
So they're working with part of their book as a solo practitioner, and then for more complicated cases, they're part of a team.
Right, and they have to follow the rules of engagement, because if those clients are private banking clients, then they need to bring in the wealth team and the private bankers involved in those customers. Otherwise, it just causes more angst. It's one of their responsibilities if they become a senior advisor.
Ken, I'd be interested to understand a little bit about how the decision tree is along the way of where the asset flow goes. So as the planning work is done and as the need to implement is done, are there rules of engagement, or are we just taking into account obviously what is the best solution for the client? And that may end up some on the advisory platform, some may end up in brokerage, some may end up at trust, and how does that whole experience come together?
We use the dollar amount. I think Bruce mentioned 3 million. We use 2 million as a guideline of where we require a portfolio manager review of the account, and our PMs are able to offer more customized portfolios. So that's what we use as our rules of engagement.
And what we're doing to gap that 1 to 3 million space, we've taken those clients and we still have a portfolio manager, but it's a centralized desk versus the portfolio management team that's going to work directly with the client and the financial consultant at 3 million. But we believe that there still needs to be a portfolio manager reviewing that the allocation. We can still give them customization and tax efficiency through using Smartly. But it just, there's too big of a chunk of clients between 1 and 3 million. You can't afford to have enough PMs out there running around over the country trying to do it. So in that team approach, they're using a centralized portfolio management team to look at that from 1 to 3 million space.
We've done something a little different in that space as of about 3 years ago that seems to be working pretty well. We've instituted private bankers, and I hate the term private banker because it means 1,000 different things in banking, but these are private bankers who are most CFPs, they're wealth advisors, and our referral guidance is anything over $1 million should go to a private banker, but the private bankers are able to either go to an FA for the investment part of the relationship or a portfolio manager for that $1 to $3 million range. So essentially they're the bridge between brokerage and the trust platform to make sure the client gets where they're best suited. And as you all know, that's a very subjective facts and circumstances assessment that has a lot to do with who's in the market and personalities and all that, but that's working pretty well. Still not all sweetness and light, but it's working pretty well.
Tim, I see that Bob Carr has raised his hand and joined the group.
That's right. Bob, if you're able to unmute yourself, go ahead and ask your question. While we're waiting for Bob to work on that, he actually sent it to me as in text form as a backup, which I love. So Bob asked, have you reassigned existing financial advisor high net worth accounts to work with the teams? And if so, did you compensate the losing FA?
We have not, because a fundamental rule of thumb to me is I'm never going to do anything to disrupt a client who's happy with who they're working with. So I'm willing to accept that exception to my segmentation scheme, frankly, to keep the FA and to keep the client happy. But if the FA leaves, then we're going to try to migrate those clients to channel we'd rather have them in.
Yeah, I'm with David. We do not do that. You know what? The hardest thing in the world to do is convince someone to give you their hard-earned money. And if you build their relationship, the FC with the client, and they say, here's my $2 million, I'm not going to go there and say, hey, I know you trusted this guy to give you $2 million to you, but I, Bruce Hageman, have decided that since you're so wealthy, I'm going to give you to another broker that you don't know. So we do not reassign whatsoever. If you're lucky enough to find a $2 million customer in the branch and they want to do business with you, as Jim said, we're going to set you up with the team out of the wealth office because you get a private banker assigned to you at that level anyway. So I never take a client away unless you're forced to, like David said, if someone leaves.
Thank you.
What about the model of taking the kind of private banker that Dave was describing, a kind of a not a lender but a wealth advisor, and registering them so they could do that business directly, as opposed to needing someone in the team to do the brokerage business?
Ours are registered, but they are only registered so they can get paid on brokerage commissions. My view is if they're managing accounts, they're never going to have time to do business development and relationship management. They're going to be more focused on dropping tickets than they are managing relationships. So we do not allow them to be the broker of record on accounts.
That's typically what we see as well. I think there's, Ken, I think at that level, there's some desire to share compensation, but if you start thinking about the process of getting them licensed, and then, that doesn't necessarily turn them into somebody that's got the experience that a senior financial advisor would have to become part of one of those teams. And I don't know, Dave, I don't know how you feel about that, but that's part of the way I see it too.
I agree.
Yeah, we've tried 4 times. I've been at the firm 21 years. We've had piloted bringing private bankers or brokers, making brokers be more private banker-like, or private bankers being more broker-like. It's never worked for us, and it could just be us. But what we settled in on is that we're going to have a financial consultant, but not only do I have the RMs be licensed, But I give them, they get 6% of the revenue on their reoccurring assets every year. So they want to build the reoccurring asset book just as much as the FC. And I charge the FC 3% of the 6. So if the FC is getting an average of 38% on that piece of business, they're getting 35, and I'm paying 6 to the banker. So every year they build that book, and now that banker is getting a 6% reoccurring revenue on the book. I think it keeps the banker here, and if the broker tries to leave, the banker is going to try to keep those assets with us so that they keep getting paid. But we have not done. We failed when we tried to make a combined one person do it all kind of concept.
What kind of other compensation strategies have you used to make these teams work?
We've done a couple of things. One of the things, today our financial advisors are the biggest, is our best referral source for trust. And what we've done is a couple of things. The main one being, we've educated them on, if your client needs to be in the trust department and has estate planning needs, you need to introduce them to trust. And when they do that, they stay as the account manager, but the account is on the trust system and they have a trust partner. They get a haircut on their compensation, but a haircut is better than getting your head chopped off when the account goes somewhere else because you didn't introduce them to trust. So we've done that. And then also, to the point that Dave and Bruce were making with our private bankers, we've also licensed them, and they can earn compensation. And we license them for the same reason that Dave Hansen did. We've also, I'm looking at Kelly's picture. We're an e-money shop. We've given all of our private bankers e-money, and we're next thinking about giving it to our trust folks as well. What we want these folks to do is really start aggregating accounts or the client's information. We think in the long term, whoever is the account aggregator is going to be the primary relationship for that client when they consolidate. So that's a big initiative for us, is how do you educate these folks on how to use e-money in their practice and gather as much information on their clients as they can so that we end up being the account aggregator for the client.
Yeah, and just to chime in there, Rams, I'm glad that you brought this up, because when I think about, this handoff process and a team-based approach, if I think about it, obviously from the lens of e-money or a software provider, you want to make sure that, when you do those handoffs, that, that private banker doesn't need to start over again with the client relationship in the system that they're using, or start over again with the account aggregation. And I think that's one thing that we've done really well, is build a platform and a client experience that, as the client relationship maybe gets more sophisticated, or maybe there is a handoff to an FA or private banker, you can still maintain that same experience from the end client perspective, the same logo, but it's just a new person that's going to be involved and engaged as part of the conversation. And so I think that's worked really well for us with that model.
We've had a question come in from Paul Haynes that I think kind of speaks to the conversation that's happening right now. So to the rest of you on the same topic, does your current compensation plan allow for neutrality between a financial advisor referring a client to trust or putting it on the brokerage platform? Also, do you incent your financial advisors for private banking and trust referrals?
So I'll take part of that. In regards to the advisor portion of our RIA platform and the investment management and trust platform, the advisor fee is exactly the same. So in other words, you always have the firm fee and custodian fee and everything else, but the advisor fee is the same in both areas. So we did put a committee together to make sure that we did that for both programs. Having said that, with the investment management and trust, we are going to have a haircut because there's more people involved in the advisor fee portion. In other words, we're going to give a piece to the portfolio manager and the trust advisor for those programs. So that's how we've established it in terms of compensation on that one product. Everything else, we've done the same thing as said earlier. We've licensed our private bankers and wealth advisors, but we only allow the senior investment consultant to actually be the salesperson in terms of soliciting investments. You can only have one person with every household being able to do that. But the reason for being able to get licensed is to make sure you could share in the compensation, or you could share it by scorecard, because we have quarterly goals associated to everybody.
Yeah, I've been trying to solve that problem for 35 years, and I've determined it's not solvable. So we do not have compensation neutrality. Frankly, that's why we have two platforms. If an FA is going to be the lone wolf and handle something on their own, they use the Raymond James platform. I know exactly how much that costs me. It gives them all the tools they need and products they need to take care of that client really, really well. And I know I've got a decent margin on that business. There's no way I can pay them the same to put that same client over on the wealth side, have all the costs of a team, have all the costs over and above what it would be at Raymond James, and make any money. So I've given up on trying to have compensation neutrality and just try to rely on rules of the road and segmentation schemes to deal with that. And it won't be perfect, but it works okay.
Well, Jim King, I think you have compensation neutrality, I believe. Is that right?
Well, we have plenty of sharing that goes both ways. I mean, so there are incentives for investment advisors to get business to trust and vice versa. So we do have that. We have wealth advisors that are out there hunting, and they're fully licensed, and they can do that business. So we've gotten there. Our program is a little more driven by the communities that we're in and the way our bank has been built through the community bank network. We're not in a lot of metropolitan cities. So we've got teams, loosely used teams, meaning we have investment professionals and trust professionals that work together. Less teaming, but in a team atmosphere, clearly financial planning based. Our private bank in the bank side is a little bit different because of our the ability for our community banks to run kind of autonomously, which is a little bit of a challenge. Kim, one thing you and I talked about as we were talking about this today is one of the challenges in our markets are finding and getting those managers to have the skills and the expertise to be able to manage and oversee both trust operations, trust business, the regulatory environments, as well as the brokerage. So managing one regional manager, managing those two teams can be challenging.
Ken, let me mention something that a lot of firms have done, or some firms have done, I don't know if I lost the right word, that I think also helps some of the integration. We have our RIA that with the Chief Investment Officer and Investment Committee that provides investment model and our investment philosophy for the RIA. Our trust department has hired them to provide investment services for our trust department. So if you're a trust officer or an investment advisor or a planner or a private banker with our firm, you're always talking to the client about similar models, similar processes, and similar offerings. So it's uniform and consistent. So we don't have the issue of, well, my platform's better than yours because I've got this investment or you don't, and vice versa. So it's uniform. So when they're talking to clients, whichever discipline they're in, they're always talking about the same investment process and investment products. So we think that helps us be more consistent and provide a better client experience. And I know other firms have done that as well.
I think Hancock Whitney, I believe, for example, right?
Yes, we did the same thing. We felt that, our clients, whether they're, have 500,000 or 5 million, or even 100,000 or whatever it might be, should have our best thinking. So we put together a process which utilizes our intellectual capital for asset allocation modeling, as well as the firm to do its due diligence on product selection to provide that to our customers. Obviously, minimums are different for every product set, but it does allow for that type of process as well as value proposition when you're talking to our clients.
So just an alternative view. I love Rome's and Miles, and I have total respect for companies that have done that and done it successfully. My view is if I were to do that, I would limit my ability to pick off FAs from Merrill Lynch and UBS and other places and bring them onto my brokerage platform, because I would not have as robust a product set as what they're used to. So I opt for taking Raymond James as it's delivered to the 6,500 FAs they have, and that makes us really, really effective at recruiting people to that platform. And I deal with the reality that if I have a $1.2 million client with an FA, they might have a very different investment experience than a $1.2 million client on my trust-based wealth platform, but I'm okay with that. They're both defensible. They're different standards, but I'd rather have the recruiting flexibility of a robust brokerage platform than the consistency of an investment platform.
And I think that model seems to make sense. Although when you look at it from through the investor lens, the consumer lens, you might want to be on both platforms, right? You might want to have access to things that your Raymond James broker can't provide, and vice versa. So, and that's the dilemma in terms of customer centricity pulls you in one direction, but it hurts you in others.
Well, and I thought when we instituted our private banking model that we would have more clients with assets on both platforms. And it's amazing how strong psychology and platform and culture are, because it just doesn't happen. I mean, it's just the person who controls the relationship. It's the old adage of if the only tool I have is a hammer, everything in the world looks like a nail. I tend to see things through the lens of the platform I'm comfortable with, and people tend to end up being all wealth platform, trust wealth, or all brokerage. I hope that we see more clients on both platforms over time, but that's a hard lift.
How about the rest of you in terms of that sorting out of customers? Do you see clients straddling the two platforms, or are they sorted out the traditional way?
So Ken, for our true wealth advisors, the ones that are interested in the wealth bank, every one of the clients has a brokerage account with us. And then it tends to be, and I'm rounding, around 55% have some money on the IA platform, because it's a smaller minimum. And only about 20% of those clients have 3 million or more on the trust platform. So I think having all three platforms available to the wealth advisor and doing the same thing where, when there's so much market volatility, instead of, you may have money on the trust platform, but you might have bought a structured note to hedge the market, right, in your brokerage account. So not every client is going to have all three, but every one of them at least has a brokerage account. And I think that's where we start that relationship, and then we try to bring in, and we don't have a strong wealth bank. This is truly a commercial bank and a retail bank. So maybe other people are more successful than we are at it, but that's what our group looks like. I don't know if it's right or wrong, but like other guys have said, it is what it is. That's what we have, and we try to get as many people as we can and do as much business, but it's still that's where it ends up.
Have any of you migrated a group of clients that would be better served on one platform to another platform, recognizing that the same relationship person would be able to handle that relationship either way, but one platform might be, more cost effective for them, better, presentation of the information? Has there been any of that in your books of business?
I'll answer quickly, because we went to the model where we want anything under $3 million on the IA model versus the trust model. It's a client experience. Again, it's a trust experience. We sold them the trust platform. The broker was there. The PM was there. I'm not going to break that trust. I'm not going to break the commitment we have to them. We're standing pat. If whatever you have, is what you get to have. If you want to change, we'll let you change, but we're not going to force that change and ruin that client relationship, because it's way too hard to get that client to commit anyway.
Yeah, we follow the same philosophy of the relationship that the advisor has worked on throughout the years to build. This is the most important relationship, and that's why these clients stay with us. May not be the reason they came at the beginning, but it is certainly the reason why they continue to work with us. What we have done in terms of migration is really from the bank side. In other words, we've been able to work closely with a commercial bank and move some clients from those wholesale relationships to the private banking relationship to build that cross referral. And then just recently, as we continue to pare down the private banking book, because we ended up having 300, 400, 500 clients for private banking, and there's nothing private about that. So we started to further define that client segmentation by moving some of the private bank clients over to the mass affluent market, to the premier type banking program, which we call professional and executive. So we've done some work in that area, but we haven't moved them out of the advisor themselves, because we do believe in that relationship.
I think quite a few firms have moved assets, if not clients or relationships with the advisor by moving their agency business off the trust platform and putting it on the RIA platform.
Yeah, Ken, we see a lot of that discussion at times around the client experience for the smaller agency accounts and just the cost to keep them on that system. We hear that discussion a lot when we're inside of financial institutions, banks that have trust departments, and they're thinking about the vertical integration, but they're also thinking about what's the best client experience opportunity for those smaller agency accounts. So we have seen a lot of discussion around that.
Peter, I think the critical thing about your question is I think you framed it as the same relationship manager, but a different platform.
Right.
We don't really have that set up. I would do it if there was a better platform. The key to me is to keep the relationship manager the same.
Absolutely.
I love the big banks because they love to put in place segmentation strategy that force clients to a new RM, and that generates a lot of new business for us.
I think, and you might be able to expand on this, but it used to just be the trust group in the retail investment area. And now it sounds like many of you have the RIA in place or an RIA in place. And I think, in essence, that's almost the third player in that as far as how to best meet those clients' needs. And it used to be, a client would go on a trust platform that didn't need trust. And that was the problem from a migration standpoint. And now you don't have to give them trust or charge them for trust if they aren't using trust. And maybe that's what you're all doing when you have your own RIA.
But I think for 15 years, most of the clients that have gone on trust platforms don't need trust. I mean,
right.
It's been 80, 85, 90, depending on who you're talking to, % investment management agency business. We don't have an RIA just because I don't see why I need one. I can manage discretionary money on a trust platform just as well as I could in an RIA. But
well, we've been getting a lot of questions coming in on the chat line. Anyone pop up that fits into this conversation, Tim?
Sure. So we've had some in the group seem eager actually to turn to the role that financial planning can play in managing some of these relationships, and I know that that's coming up. Mm-hmm. We also had a question come in around margin, which I think will be great for the conversation around separate P&Ls.
Mm-hmm.
Here's one that actually just popped in. Any thoughts on moving non-trust accounts, i.e. investment management accounts, off of the trust platform to a fully disclosed custodian, which reduces costs and the client interaction typically improves depending upon the technology?
I think that's that agency question that we were just on, that agency question to some extent, right?
Yeah.
Yeah.
Yeah, and I'll just chime in again since there's quiet time. Right now, we're so new into the last 2 years of doing this, but our strategy right now is we're moving the minimum, middle of this year, we moved the minimum from 1 million to 3 million to use the trust platform for agency accounts, right? So agency accounts, we're trying to push them to the RIA side for several reasons. It's more efficient, it's cheaper, at least for us it is, cheaper, as a lesser fiduciary standard. It doesn't, it's not regulated by the Fed, which is more difficult to deal with. But again, we're gonna keep moving that up until at some point, hopefully, all agency business, the plan would be, but we don't want to ruin our business, right? We don't want to ruin the relationships. We don't want to, have portfolio managers lead. We've got it very stabilized. We're going to just do it gradually, keep moving the bar up a little bit. But the clients that have the agency accounts, again, we may someday, be rich enough and have enough money that we could lose people if we move their platform. But when you move their platform, if you can't match it, they'll have a taxable event, and just don't feel like I want to do that. But we want to start doing the right. There's never a wrong time to start doing the right thing, and for us, the right thing to do is to put more agency business onto the RIA platform, because there's absolutely, I think I remember it was David that said it, but 85 to 90% of our business is agency. It's not a true trust, so it doesn't have to be on that platform.
We're experiencing similar things where we're trying to move some of those smaller agency accounts onto the brokerage or RIA platform. Just makes sense. Ours is legacy business that's been around forever, and we're not to the $3 million number that some of y'all have thrown out. We're trying to move that number up, where we identify what is a good trust customer. But clearly we've had the opportunity to begin to work some of those smaller accounts onto the investment advisory and brokerage side. So
kind of sticking with the topic of, sticking with this topic, but, maybe a kind of a different angle. We've had another question come in. Is anyone moving their current brokerage advisory business away from a third-party BD to an IRA for a more efficient fee structure? So looking at those of you here that work with third party.
I would say Dave's not thinking of that, right? I guess the rest of the panel has their own BD. So yeah, right. Yeah. Well, we've talked some about the client experience, and we probably want to circle back to financial planning as a way of creating a uniform customer experience across segments. But if we're trying to improve the wealth management client experience, it's helpful to really have a better understanding of what the client's really looking for. In eMoney, advisors have just completed some research looking at some important intergenerational differences in what clients want, and has found some disconnect between the advisors and clients in terms of what each of them thinks the other should be providing. Kelly, can you run that research by for us?
Yeah, absolutely, Ken. Thanks so much for teeing that up. I'm going to go ahead and share my screen now. Let's see. All right. Can everybody see my screen?
Yes.
Good to go here. Awesome. So as Ken mentioned, I'm really excited to be here with all of you today and share our latest research at eMoney Advisor. So for anyone part of this session today that joined our eMoney Summit 2 weeks ago, we hosted our annual summit and we did this year virtually. And our head of financial planning at eMoney actually presented this Power to the Plan, the Advisor Revolution financial planning research. And today I'm going to give you guys a little bit of a modified version of this, but I think it's really impactful in terms of what we're seeing evolve in the industry. So if we jump right in here, we know that there's really been an evolution of the financial advisor role. And I think a lot of that is because of the fact that client needs and client demands have changed over the years. So that's really forced advisors to change their roles. It's forced them to really look at the services that they're providing and how to create, much like we just discussed, the right model around the client, ensuring that they get the right advice based on their needs. What we did at eMoney is we talked to different industry experts to really determine what the top forces are right now that are influencing advisors in their roles, and really what we're hearing directly from clients in terms of their needs. So jumping right in here, these are really the top 3 things that we saw come up in our research as key forces. So number 1, generational shifts. When you look at this, and you really look at Gen Y and Gen Z, they're the first mobile native generation. So, they're using iPads before they can even talk. And they're also doing things later. They're getting married later. They're making life decisions a lot later. And there's a whole emphasis on this idea of advocacy and values. And they're really focused on value-based investing and making sure that their, plans are really customized to their needs. When we also look at this generation, it's the most anxiety-prone generation out there. So an emphasis on total wellness is really important when it comes to planning. And I'll talk in a little bit about what that actually means and how we define total wellness. The second theme that we really see here is artificial intelligence. So that's AI and big data. So, things like Siri and Alexa with voice assistant to smart homes to big data. These are all really influencing the advisor and their role to be able to compete. And really what's bringing these 2 forces together, and at the end of the day, what I think the end client is really emphasizing, and you'll see that through this research, is a need for personalization and customization. They really want to feel like it's their plan and their relationship with their advisor. So if we break down this in a little bit more detail, let's take a look at each one of these forces that we see. So one of the key insights that we found about AI and big data as a major theme is it really enables advisors to focus on tasks that drive client value. So it essentially helps automate the lower value tasks so that an advisor can really focus on what's most important, which is at the end of the day, building that client relationship. Another piece of AI and big data is really automating the financial planning experience for a broader client base. So what we found here is that over 50% of advisors saw AI improving the financial planning process and overall experience in the next 1 to 2 years. So you can see here some key highlights. They see it as really saving them time by making planning suggestions based on, the data that's already in the platform. Client insights, so again, really showing them opportunities to maximize a client's financial situation and customize recommendations. And then benchmarking, we know that's a huge opportunity, allowing an advisor to compare a client situation to other households of the same demographic. So now let's look at it from a client perspective, because I think that really speaks to the opportunity from a firm and advisor basis, but I want to focus on the client perception of AI and big data and really how comfortable they are with it. And you can see right here on the screen, the answer there is it's different generation to generation. So you can see that Gen Y and Zers, they're very comfortable with financial advice from a digital assistant. That is something that they're totally open to, versus you can see only 38% of Gen X and baby boomers are open to that. So I think the big takeaway here is, although their comfort level may vary between these two generations, what it's going to allow the advisor to do is create really personalized advice and the right model for that particular client. When we look at this in a little bit more detail, according to our research, 80% of clients we surveyed trust that their advisor is actually giving them unbiased advice. And that's pretty great news, right? They trust their advisor and the relationship that they've really built with them. We also found that 2/3 indicated that they talk about life goals, debt and insurance, and business planning. So they're really covering those topics that are more personal. And that brings us to this new concept of total wellness, which I touched on in the beginning. So total wellness, as you can see it, is really that intersection between financial, mental, and physical health. It's really tying in these themes and having conversations more focused on these with clients. What we found is over 60% of advisors see the importance of talking about total wellness. So, they understand the need in the market. We also found that when you look at these generations here, Gen Y and Gen Zers are 70% more likely to want advice related to overall total wellness. So they're really interested in it. I think that Gen X and baby boomers are not quite there yet, but I think this really shows us a great indication of where advice is going and what the future client is looking for. So clients may want it, but that really begs the question of how comfortable are clients actually sharing that information, and really what does this opportunity look like? So if we move to the next slide here, and we break this down by generation, you can see that when it comes to end clients, especially the younger generations, they're comfortable talking about these total wellness topics with their advisor. It's something they proactively want to do, versus Gen X and baby boomers are not quite there yet. So again, this is really interesting, but now let's tie that back to, we know that the Gen Xers and Gen Zers are comfortable talking about it. We know it's something they're interested in, but how often are the advisors actually talking to their clients about this? And when we get into the next slide here, we can see that this is a breakdown of the different total wellness topics as we define it in our research, and how much the advisor says that they're talking to the client about it versus how much the client actually says that the advisor is. So hopefully what you take away from here is there's a major disconnect between what the advisor and client are saying about addressing total wellness topics today. And I think what that really brings us to is the opportunity and the why behind this. So actually what we found through our research is clients are more willing to pay for their advisor to expand their role into total wellness, and they would actually give them more business if they focused on these three key areas related to total wellness. So maybe it's not something that an advisor is offering as part of their business today, but as you think about the next generation of clients and recruiting and bringing in new advisors into the firm, this may be a really great opportunity to expand the conversation beyond just traditional wealth management. When we look at the next slide, there's different ways that you can kind of tackle this. There's kind of different phased approaches. So it can be as simple as referrals outside of your business. This is one very simple idea where you have your experts in those key areas related to total wellness, and you can refer out your clients to those professionals. The second piece of things here is really, professional associations. So tying to that theme and really positioning yourself as being able to deliver that type of model. And then the third thing is new skills and licenses. So this is really changing the advisor model a lot. So it's them really getting certifications and expanding their professional development into being able to provide advice at these roles and more formalizing it. But that's a really simple kind of three-pronged approach for how we see firms tackling this today. We also found at the end of the day, when we completed this research, that 73% of clients were more likely to provide more business to their advisors for value-based planning and this idea of total wellness planning. So hopefully, I ran through that very quickly because I wanted to be sensitive to time today. There's a lot that I could talk about for a long time on this topic, but hopefully, you see the value behind this research. I think as we think about financial planning and we think about the advisor's role, it's continuing to change and expand over the years. And the idea of financial planning is now starting to really get into this area of total wellness as well. And I know that, for some firms and some advisors even that I talk to, this can almost be a little intimidating because it's so sometimes far out of what they do today. But I think it's a really great indication for the fact that clients need and want advice, and they really look to advisors to be their trusted advisor and trusted guide in life decisions. And I think that especially in 2020, we've all seen rapid change happen quickly. I think we're prepared for it going forward. And, I'm excited to be able to share this research with you all today, and hopefully we can expand upon it even more.
Thank you, Haley.
Yeah, I'll pause there and turn it back to you, Ken.
Thank you. So it seems like a lot of firms are using financial planning as the way to bridge across the different segments and different platforms. Can some of you sort of share your thoughts on how you're using planning to essentially, if you will, grease the integration you're trying to accomplish in your firms?
Ken, I can start. This is Rome's. You know that we implemented a financial planning program about 20 years ago, and we've kept it pretty much the same. It's complementary. It's dedicated planners that don't sell, salary based. They're all CFPs. Average tenure now with our company is about 18 years. They use, they're not doing the financial planning the way we used to do it. They're really doing life event scenario planning. A lot using, again, e-money, doing a lot of what if for clients, not handing them a book. The plan is a living document, or a living virtual document, I guess, if you call it. And what's interesting is a number of our planners now have gotten designations. We have like as life coaches. And what they're doing is, what we're starting to do is do fee-based for that kind of stuff. So the initial plan is free. We'll do an annual review. But then if they want additional, and if our planner has a life coach designation, they're charging a fee for that. Also, about 10 years ago, one of our planners built out a multifamily office for us in Nashville. So they're incorporating a lot of the concepts that Kelly talked about. We're not actually using, she's referring out some of the physical and mental services that the clients want. We don't have it in-house. I don't know when we'll ever get there. So our planning program is starting to evolve from a plan that was a book that you gave the client, and they came back and you looked at it with recommendations to a living electronic document that then is supported by life coaching and stuff that a family office would typically do for you. And we're starting to see, for a while there, the family office is starting to really get traction now with some of the things that Kelly described.
So Ken, this is Bruce again. Sorry, Kelly, we use Money Guy Pro. I didn't know e-money existed when we signed them. So
that's okay. Money Guy Pro is great too. The first thing we did with the financial planning, Ken, was we have a firm-wide risk tolerance questionnaire that has the asset allocation models, and we use that for the high net worth client all the way down to the brokerage client, so that everybody's getting the same experience no matter what platform you're being put on there. From an investment standpoint, I know John Woodford's done a lot of work with your group, Ken. We're certainly not where we want to be, but we do a lot of plans. We have three planners that are full-time.
We've also given access to all the wealth RMs, the planning software. They tend not to use it. The FCs do. It's a lot of work if you put a plan together. Rome's was saying more of a modular or a life event. I can't remember what the words that he used, but you know, Money Guide Pro is going to more of that menu look as well. Pick what you would like. I know that maybe eMoney's got it, Kelly, but the disappointment for me on financial planning tools right now is we need to have an aggregated view of the client. You know, we can't, if you're going to, I believe that financial planning is failing us because you take all this information, you put it in one time and you get this booklet and then you have to redo it again. You got to go out and collect all the data again to update it. And are you getting where you want to go? And I know that Money Guide Pro has told us that they're coming out with an aggregator where the client can agree to have it in there, which then I would be thrilled because, you know, I redo my financial plan once a year, but it's me giving all my data to, you know, one of the one of the 3 financial planners. They plug it all back in again, and then I get a plan back. Maybe that is the right way. Maybe you should only look at it once a year, but if you're only going to look at it once a year, it should be a whole lot easier to do it. So what we're finding is the brokers are tending not to do the full financial plan. They're doing the modules. Is it retirement you're planning for? Is it getting married, or is it buying a dream vacation or home, or a college education? So I'd like to see us do a more holistic view for the client, but I think until technology catches up where we can have an aggregated view, it's going to be tough to keep pushing it. But I do like the fact that in the financial plan is embedded how we want to manage money, our house view, our asset allocated view, and it can be used across any one of our platforms, no matter who's using it, and they're going to get the same client experience. Thanks.
Yeah, Bruce, I mean, you're exactly right. We see statistically that, you know, those clients that have aggregated, you know, through our systems, even if they only have 1 or 2 goal-based type things, that their attrition rate, their new asset flow, their satisfaction rates, and all that go way up, and that you know, we're seeing and tracking how often they're looking in there at their you know, their goal versus what's happening in the market. And you're right that it's important to have that aggregator tool and have their ability in kind of real time. And that's almost it's almost moving towards table stakes, quite frankly.
Yeah, I agree with that. We started the aggregation with our financial plan. We use Money Guide Pro, and we use Yodlee for the data aggregator. And we started that about a year ago or so. Slow adoption, you know, continuing focus, more training. And at this point now, we have over, you know, $500 million in outside assets that lead to other opportunities to provide holistic planning. So everything is integrated with the Money Guide Pro financial plan. More work to be done, but I truly think this is a game changer. When you're going out there and you're trying to grow assets and make that the bottom line, this is how you're going to be able to provide it. You have to look at all the assets when you do an asset allocation model, and you're able to get assets, whether it's that 401k from Shell or that HELOC across the street, you know, whatever it might be, you're aggregating everything for that customer in a plan. And with a client portal that allows the customer to look at all the assets they have, along with somewhat of a dynamic financial plan, you're able to look at the overall solution versus how did the investment do when the market went up or down the other day. You're able to look at the entire portfolio of that customer when you're putting the plan together. So we think it's a game changer. We're really focused on that in the future with financial plan as a difference maker with our customers.
You know,
Go ahead, Jim.
I was just going to weigh in on the aggregation issue. I mean, it is a game changer, but that business and that science has got a long ways to go to be more effective and more efficient. It clearly does add great value to the plan to be able to aggregate all those assets, and it makes the ability to win assets to your platform. But my hope is that the aggregators of the world will get better.
Yeah, I think, Jim, to jump into that point. I think aggregation we're seeing as for the benefit of financial planning and the advisor, it's table stakes, right? It's great to be able to aggregate everything, but what do you do with it then, right? You need to be able to tie it to your financial plan to be able to have it be a living and breathing ongoing plan. And I know the great thing about client demand and advisor demand in this industry is it makes software companies get better because we constantly need to evolve to keep up with change, and simple things like moving away from data aggregation as scraping to API feeds. That's a shift that we've done at eMoney, and we think that is so important to our business because we know aggregation's core. Another thing that I think is so important is you have aggregation as a way to increase share of wallet. You have it tied to financial planning, but then it's also analytics. Like, how can you set goals on planning metrics for your firm and your advisors if you don't know the analytics of where you're at? And I think that's so important to overlay on top of aggregation and planning is the analytics of like, how many of my advisors have built a plan? How many scenarios do they have in that plan? How many clients are logging into the client portal? So I think that's the last piece of things that I'm really passionate about when it comes to aggregation and planning.
I think that stuff that, just one last comment on that. I think, Kelly, what you talked about with AI and what you just mentioned on data aggregation and data overall, it's just unbelievable where technology has taken us. But what I also think, though, is that we still have a gap there because we're bringing all these different technologies together, and advisors are putting together plans, whether it's through centralized financial planning divisions or themselves. But the end result is that the plan isn't going to sell itself. You still need to be able to communicate this with the right level of emotion and passion to get your customers to react. Otherwise, it just becomes like anything else that's sitting on the shelf, gathering dust. Whether it's in person or virtual, that's what it is. So it's so critical, and I just use as an example as we're focused so much on life insurance and in this industry and doing life insurance. And all plans have life insurance. Well, why aren't we all doing 25% or 45% in life insurance when we have so much opportunity there? Because the connection's still not there. The plan only goes so far. You still need the advisors to connect with the clients on an emotional level to get them to implement all these beautiful plans that we have out there.
Yeah,
Jim, I think you're right, Jim. The connection, taking that plan and really using it with the client to motivate action, to sell life insurance, whatever the case may be. If you're truly managing the risks of a client and you see the need for insurance and don't act upon it, we're missing the boat. But
the connection is where the value is. The plan is worthless. The document is. I remember I had lunch 18 years ago in Nashville with a guy who had been named as one of the top 50 financial planners in America. And he said, let me tell you a dirty little secret. I haven't done a financial plan in 2 years. And the point was, financial planning is not the document. It's the relationship with the client that they look to you as more than just an asset manager. And that's what matters. I frankly think our industry has done a ton of damage by handing people documents that said financial plan on them that never got open, never got read. And the client thinks, oh, I'm good now. But it didn't fundamentally change the nature of the relationship. So to me, the focus is on having a relationship that's comprehensive, not producing books. But we certainly have the ability to produce lots of books, and we have lots of people who can do it, some full-time, some part-time, some for a fee, not for a fee. But it's more about the relationship, in my view.
And so why haven't we got there yet? If we understand that, right? You can't say that. What percentage of your advisors do you think are there?
The ones at the top of the list in terms of productivity.
So you think it's a direct productivity?
Absolutely.
Mm-hmm.
Ken, I think that it's a lot of what was spoken about with the aggregator and the integration of the tools. I mean, when we say the word financial planning, and you think about a client experience across a fairly broad spectrum, that really means a lot of different things. Certainly in the high net worth space, at $3 million and above, that means something a lot different than somebody maybe with $500,000. But that doesn't mean that person doesn't need to have a baseline plan, and those FAs and advisors need the tools to make that process, kind of table stakes. So I think as we think about this, we have to think about the tools and the integration and the aggregation of those things to even do baseline financial planning, or let's call it advice, if you will, and then work up the tier. And I think that's been the challenge and is the challenge, because that phase, if you don't have that, and if you're trying to go to a separate place and bring in the assets and put input, it's just, and then if a centralized team is doing it, then you sometimes struggle with the passion around, or the ability to deliver the plan and understand and not be afraid of it. So those are the challenges. I think we understand it, and we're day by day kind of hacking away at them, but it's that integration that ultimately makes it work.
It's better than it's ever been, but it's got a long way to go.
Yeah, I think, Ken, to the point that you just made, and I agree with Dave, you think about our industry 20 years ago. 20 years ago, we had a trust department and we had brokers. And brokers were selling annuities, and trust was selling trust. Look where we are now. I know it's been 20 years. Maybe the timeline's been too long, but now we've got integrated wealth management, working in teams with incorporating technology, leveraging planning. So I think we've come a long way. Now, you can always argue, is 20 years enough time? Did it take too long? But I think we'll make more progress in the next 5 years than we've made in the last 20. I mean, that's just typically how it works.
Mm-hmm. Mm-hmm. Yeah, that certainly seems to be the case. Mm-hmm. And we're at Kehrer Bielan, we're trying to stay on top of that and monitor that. Tim, why don't you put up that other slide? We've been using this study group, sort of supplemented by case studies we work on, to try to monitor the kind of integration that's going on, what the barriers are, how they're being overcome. But we think now we'd like to move toward more formal benchmarking of the various kinds of integration efforts that are going on, as a way of moving in the direction of understanding what best practices are. And as we look at the landscape of information out there, it appears that there really is not a place you can go to benchmark personal wealth management services in a financial institution. You certainly have all kinds of ways of places you can go to get benchmarking of the brokerage business or benchmarking of the trust business. But if you try to put together the personal wealth management business in a bank, meaning stripping away institutional and retirement plan services and the other things that go on in the trust structure, and say, how are we serving the wealth of individuals and households, and how is that business performing? I don't think we have that. I don't know of such a tool, an information tool that's available. So we're trying to move in that direction. And I just put on the screen the kind of benchmarks we would like to achieve for that, from that perspective, both so asset and revenue growth, the asset productivity, client productivity, staff productivity, and client penetration. And when we look at the available data that we can get our hands on, we can pull a lot of that from existing either regulatory data or surveys that we're already doing or have access to. But what we can't do is to be able to get out, I think, two core questions: the cost to service and the cost to acquire across different ways of providing wealth management services. And to do that, what we really need to get from you in the field are the ability to segregate your staffing between who acquires and who serves, and what's your total payroll for those two groups. And if we had that, given the other data we have access to, we'd actually be able to look at the cost to serve and cost to acquire in Arvest versus Fulton versus First Horizons and so on. So we'll be looking to do that in the coming year. And we'll be turning to some of you, well, first of all, everyone to participate, but also to help us refine these concepts and make sure we're heading in a direction that'll be useful to you. We, like are some of these measures redundant or silly? We left some key things out that we got to focus on. But anyway, we'd appreciate. We always learn something from you all, and we certainly could help to refine what we're trying to do. But we'll be coming at you with this enterprise come the new year. And any other closing comments from anyone before we sign off? Tim, you want to put the next slide up? Well, as we're coming to the end here, we certainly want to thank our sponsors again, Ameriprise Financial Institutions Group, eMoney Advisor, and our friends at Jackson for bringing you this meeting. Clearly want to thank those of you who sat around our virtual table, Jim and Dave Hansen and Chris, Bruce, Fuji, Kelly, and Rome's. Thank you so much for spending the afternoon with us and sharing some very useful thoughts and experiences with us. And of course, we want to thank everyone who clicked in from cyberspace, and we've had a flood of questions. We hope on the chat line. We hope we've been able to answer them. Certainly, we can follow up and try to answer them later. And then we've got a couple of more of these meetings coming up for the rest of the year. On December 3rd, we're going to dig into integrating digital advice with your advisors. And on December 15th, managing a call center on delivery of financial advice. What's happened now with advisors working more and more virtually, the line between an advisor sitting at home, smiling and dialing, is blurring with what's happening in a call center. So we'll be digging into those issues in December. And we hope many of you will join us then. So thank you very much, and see you next time.
Thanks,
Thank
Tim.
you.
Thanks, Ken.
Thanks, Tim and Ken.
Enjoyed it. Great job.
Thanks, everybody. Bye.